Are you worried about picking the wrong out of state market for real estate investing and watching your first potential investment go sideways fast? This fear is real. You can easily pick the wrong market where you'll always be struggling to find a good tenant, or one that maybe you just got in too late and you could be on a path to losing money. So in this video, I'm going to share how you can select the right market for your investment goals to give you that confidence to get off the sidelines and into the game of out-of-state real estate investing. So let's get started. I'm Veronica Woods. If you're new to the Real Estate Wisdom channel, I provide market updates about what's going on in real estate in the Philadelphia and surrounding Delaware County suburban market. I also share tips about how to build and maintain a profitable rental property portfolio. This is the second video in a series on out-of-state real estate investing. In the first video, we covered debunking the myths that block a lot of busy professionals from getting started in investing out of state. In today's video, we're going to talk about how to do the research that won't have you be lacking in your due diligence and defining a buy box, or another fancy word for saying your investment criteria that works for you. And that buy box is a filter that you're going to start from a metro area, and it's going to be able to get you to identify a few neighborhoods that make sense for you and your risk profile and your budget, more importantly. Before you start worrying about properties or specific neighborhoods, you got to pick a metro. So you got to start big picture. And there's some ways that you can do a high level due diligence and research to figure out if you should be investing in Philadelphia or Miami or San Antonio or Cleveland, and throw in your own metro area where you live in, because you probably know that best for a comparison. So there's a couple quick high level questions you should ask yourself. First, what is the entry point for, let's say, a starter home in that metro? So if you compare your budget versus the entry point, that may quickly filter out, maybe you don't have Miami money, or you're not willing to invest Miami money in real estate right now. So that will quickly eliminate metros. Then if you're more cash flow today oriented, you can calculate something called a price to rent ratio, which takes the median sales price divided by the average median rent and gives you kind of a proxy of the cash flow attractiveness. So the lower the ratio, the more cash flow attractive the metro is. And that might be a cut where you just kind of eliminate certain metros off the top. Then you want to dig into some economics of what are the trends going on in the area. So you look at things like jobs, people, population growth, trends in rent prices, right? So you want to know, how much you could potentially bump up the rent year over year. The legal landscape of landlord-tenant law is something to pay attention to. Usually most metros are kind of on a continuum of landlord-friendly to tenant-friendly, and they may be evolving one way or the other, and you kind of want to understand where, and that's usually more of a state level, but then individual municipalities in a state may have their own regulations, so that's something to watch. Now, where do you find all this information? You could do a simple Google search and kind of keep track of what's going on in these cities or towns or the metros. You can look at larger builders' research on areas. A lot of times, you can piggyback off the research team that a larger company has and figure out what's going on. You can also, the individual towns may have, or cities may have, a state of Miami housing report on a regular basis, and that may be available online. So really, there's a lot of information available that's already digestible. Of course, you can have Chat GPT, but they're probably pulling from some of these resources that I'm talking about here now. And another thing you should think about when you're deciding on a metro in the country is how easy is it for you to get a team together? So maybe you already have some contacts or leads to more hot referrals in, let's say, Philadelphia versus Cleveland. So that means it may take you a much shorter time to be able to assemble the right team in Philly because you have a footprint versus Cleveland. Now, for your first time around, I would say that that would be a really critical factor in picking a metro, that you have you're confident in your ability to kind of pull together a team. Now, once you've got down to selecting a metro area that you're confident in, it's time to really write out your buy box or investment criteria. Now, when I have my clients do that, I have them take a step all the way back to their why, and which also includes their financial objectives and their risk profile. Because the neighborhoods are going to bubble up as a consequence of that. And I know everybody likes to jump into the neighborhoods first, but if you don't understand how to pick the neighborhoods that are going to help meet your goals, like what's the point? So in my financial freedom framework, I always start at step one, defining what are your real objectives. Are you trying to just diversify your overall investment portfolio? Are you looking for cash flow today? Are you more concerned with cash flow later? Do you want to accumulate enough cash flow to make your 9 to 5 job optional? All these things kind of drive into your strategy of getting into real estate investing. So with that backdrop, one of the different categories in your buy box that I'm going to review are all things that you should, at the end of the day, just take a stand. There are no right or wrong answers. But once you've defined each of these elements, naturally, different neighborhoods will come up. And more people, if you can't figure that out on your own, more people will be able to help you figure out what should be on your neighborhood shortlist by how you're making decisions about your buy box. So the first thing decision to make is about what type of property. You have single family homes, you have small multifamilies that are considered residential properties, up to 2 to 4 unit properties. Then you have small apartment buildings and so on. So depending on what you want to invest in, and a lot of times this decision is a function of, are you investing by yourself? How much capital do you have? And that typically drives the decision. But let's say if you want to invest in a small multifamily, there's some zip codes that just don't have that many of them. So that's going to automatically eliminate that town from your list, even though you that may be the town you heard of. And that's just an example. So first, defining the type of asset, and you may even get into some commercial properties, mixed use, storage facilities. And I would say the bigger the property, probably the broader the geographic radius you may have to go to be able to find your target. That's probably a subject of a different video. But again, that first decision of what type of asset class you want to invest in is a very critical first decision. Second, what type of neighborhood do you want to invest in? So you'll hear people talking about defining neighborhoods by letters from A to D. So just the extreme. So a type A is generally new construction, high-end amenities, typically attracting a higher income type tenant. And then on the other extreme is type D, which is generally maybe in an older neighborhood with older properties, tend to attract less amenities, tend to attract a more working class or moderate income tenant. There's no good and bad, but stating up front what type of tenant you're comfortable with, and then there's B and C in between. Not going to define that here. Um, but it's just something to know about, kind of goes into risk tolerance in terms of the type of heavy ongoing property management that's necessary. So you'll want to take a stand about the type of property. Then you want to think about your kind of type of buy and hold investing that you want to do. Do you want long-term rentals, or are you interested in medium? There's something called a medium-term rental, for people going after people like traveling nurses, or maybe corporate executives that are staying in town for a limited amount of time. That's a specific strategy. And then there's short-term rentals like the Airbnbs. So depending on what strategy you're going after, that also may dictate which neighborhoods are most appropriate. Then it's kind of like the financial fit, right? So at the end of the day, if you look at the neighborhoods that fit how you defined those different areas, then you're back at looking at the same, some of the same metrics that you looked at for the metro. What's the entry point, median sales price? What does the price to rent ratio look like from neighborhood to neighborhood? How easy is it to rent? What's the typical vacancy rate? What are the typical rent increases or rent growth in a specific area? So all this data will help you figure out a short list of potential neighborhoods to go after, and then also having something very defined in writing. And can share I share examples of how to kind of like put this in writing for my clients, so that they can share that with other people that can help them search. Because the worst thing is for somebody to say, if I ask someone, what are you looking for in investment? And they're like, anything that makes sense. It's like, what is, makes sense to me and makes sense to you, maybe two totally different things. Once you go from metro to buy box with specific neighborhoods and other criteria, you can hit the ground running, and people can help you that much better. I find that many newer investors get stuck at kind of getting going in momentum is because they act and try to get going without any criteria. They'll say they'll look at anything. And what I coach my clients to do is take the time in the first few weeks before kind of getting out there, looking at deals, or even running the numbers for deals, to really get clear on defining their criteria over those dimensions that I discussed in this video. So you don't have to worry that your initial criteria is etched in stone, but that's a starting point to start evaluating individual deals. And from there, it makes it so much easier to refine and really find that almost needle in the haystack of what's going to be a good deal for you and add to your long-term investment portfolio. So with that buy box intact, that's your initial filter. Then you start running the numbers on individual deals. You're putting in individual property level assumptions about rents, the rehab costs are, what the financing assumptions will be, and determining whether this is a green light or red light project in terms of, are you going to move forward or not? And you get used to doing that iterative approach over and over again, which I know is not the sexy part about real estate investing for most people. I, as a finance person by nature, I love running the numbers and seeing things come out as a good deal financially for my clients. But I know that that's not necessarily why people get into real estate investing, but it is one way to really control your risk. And as I talked about in the previous video, A lot of people are worried when they're turned to out of state investing that the risk is just out of control. But if you keep yourself and your team in the lane of, I only want to buy properties that look like this, that meet this criteria, you can not only hold them accountable for what you want, but also have a way to measure if it's hitting the mark or not. So again, by having, being narrowed down to buying criteria and doing research to validate that that's the right criteria for you, really puts you in the driver's seat of managing your team. So speaking of managing your team, we're going to talk about in the next video about how to look for your team, select the team that can be that boots on the ground force to build a profitable out-of-state investment portfolio. So as always, thanks for watching and happy investing.